Hi, everyone. Welcome to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Another big show for you this week. A lot to talk about, a lot going on in markets. First, today's show is brought to you by my friends at Y Charts. Y Charts is an awesome data and analytics platform. Take a look at the show notes to get a link to a free trial to Y Charts and 20% off when you first sign up for the service. So let's start out with a blog post I put out yesterday called The Greatest Paradox in Markets. So most of the time in markets, stocks go up, stocks go down. There's not anything really particularly interesting to say about that. But every once in a while, the two greatest human emotions, fear and greed, lead to these extremes, both on the downside and the upside. So I want to run through a few examples that we've seen in the past few years. Number one, March 2020. So here we are, March 12th, 2020. S&P was down 27% from its high just a few weeks earlier. We're in the midst of a crash, and we see this extreme oversold reading where only 1% of stocks in the index closed above their 50-day moving average. So very rare condition. And what do you tend to see following such an extreme oversold condition? Well, if you look at the data, the future returns are actually tend to be well above average. If we're looking at 1 month, 3 months, 6 months, all the way up to 2 years, we see higher returns than just any ordinary reading. Now, a few months later, we were at the end of May in 2020. We see extreme overbought conditions. So really the opposite condition where 96% of stocks in the S&P 500 closed above their 50-day moving average. That was the highest reading we had ever seen. So very overbought. And what do markets tend to do following extreme overbought conditions? This might come as a surprise given what we just saw from the extreme oversold conditions. Well, they tend to actually continue to go up, where you see above average future returns going forward, again, from 1 month, 3 months, 6 months, 9 months, 12 months, and 2 years forward above average returns. So how is this possible? This is what I call the greatest paradox in markets, that you can have both extreme oversold and extreme overbought conditions both lead to above average future returns going forward. And how is this possible? Well, it's really because of the two most important forces in markets, which is momentum and mean reversion. So on the upside, when you have extremely strong returns, so that strength tends to beget strength going forward, and you see above average returns. Now, on the downside, you tend to have that other force, mean reversion. When you're so stretched to the downside, you tend to see a snapback in the opposite direction. So those two most powerful forces in markets, combined with the human emotions of fear and greed, once in a while tend to lead to these extreme conditions and this weird situation where you can have both extreme oversold and extreme overbought conditions lead to above average future returns going forward. So where are we today in terms of these readings? Well, interesting situation that we're facing today. Very sharp decline since the peak early in the year. The drawdown now is over 24% in terms of the S&P 500. There's any number of reasons you can choose why stocks are down this much, this fast. It's actually the third worst start to the year in history for the S&P 500, trailing only 1962 and 1932 in terms of where we were at similar points in those years. So very rare to see the market off to this much of a decline and this fast. And so if we're looking at that overbought, oversold reading, where do we find ourselves? Well, interesting now that we're actually down to 2% in terms of the percentage of stocks above their 50-day moving average. So pretty much everything has been pulled down at this point by that sharp correction. And so now we're at that similar extreme oversold condition. And what can we say? Well, the same thing we said back in March 2020, that when you have these extreme oversold conditions, you tend to have a bounce where you see above average short-term returns going forward. Now, does it necessarily have to happen? No, there's no certainties in markets. There are only probabilities. There are always exceptions to the rule. I think the biggest exception in terms of an oversold condition that didn't necessarily lead to a bounce right away happened in 2008. So if we look at the 30 most oversold readings in terms of this indicator, which goes back to 2001, we see a number of times in 2008 where the market was down hard. It was extremely oversold. And it had a relatively short-lived bounce, or it just got even more oversold. So we see negative returns from a number of these October 2008 readings. But if we look out further, if we look out 1 year and 2 year, pretty much every one of these extreme oversold conditions had positive returns, looking out 1 to 2 years forward. So all else equal, whether you're an investor or a trader, it's better to see an extreme oversold condition if you want to be long stocks, a buyer of stocks, because you tend to have this mean reversion. Now, it can always, as we saw in 2008, always can get more extremely oversold, but this is pretty rare to see. We're pretty much lower than 99% of historical readings in terms of this data point. And so that's pretty stretched in that direction. So any good news in the markets, and there hasn't really been any, and that's why we're in the condition we are in terms of that extreme and just a sharp move down. Any good news likely will lead to some type of snapback or bounce. So next thing I want to talk about is the elephant in the room. So we had the big Fed meeting this week, and I did my tweet the day before that I always do before Fed meetings, which is tomorrow's news today. And how am I able to predict what the Fed is going to do going into pretty much every single meeting since 2009? Well, the Fed has followed what the market expectations is every single time. So if the market is pricing in a rate hike, the Fed is going to hike rates. If the market is pricing in a rate cut, they're going to cut rates. If the market is pricing in the Fed doing nothing, they'll do nothing. And very interesting, early in the week, we saw a shift in terms of the market's expectations from a 50 basis point hike, which seemed to be the expectation for quite some time now. And that very dramatically shifted the few days before the Fed meeting to a 75 basis point hike. So heading into the meeting, it was a 95% probability of the Fed hiking 75 basis points. And of course, that's exactly what they did. And so now where are we in terms of Fed policy? Well, we're at 1.5% to 1.75%. So still very easy in any type of historical context. We're not even at 2% yet, which is kind of the Fed's long-term inflation goal. Still very easy. Still a lot of normalization to come. But again, this is happening much quicker than people certainly thought a few months ago. And if you listen to the press conference, I thought it was pretty interesting. There wasn't really a single question about the causes of the inflationary regime that we're in. So there was a lot of talk about blaming the war in Ukraine and blaming supply chains and COVID. But the elephant in the room was not mentioned, which is pretty interesting to me, that there wasn't a single question asking the Fed, well, what about your own policies in terms of the money supply, in terms of keeping interest rates at 0%, in terms of buying mortgage bonds, even though housing prices were hitting record highs month after month? Wasn't a single question on that. And so I found that quite interesting. And it really makes you question whether journalists are not allowed to ask those questions at these meetings, or that they won't be invited back to these meetings if they ask those questions. But regardless, the Fed has seemed to have gotten a pass so far in terms of now they're saying they're going to save the day by hiking rates, but no one says, well, how did we get to this place in the first place? And so just a few charts illustrating that would be good questions for people to ask if there are any journalists watching this that are at those press conferences. Well, how did the expansion in the money supply, increasing 40% over a 2-year period, how did that perhaps lead to an inflationary problem? Remember, the CPI was running at 7.5% before Russia invaded Ukraine. So now we're at 8.6%, but it's hard to say. It would be hard to say that everything is due to the war if we were already at 7.5%. So perhaps maybe this money supply is an issue. Number two, How about the fact that the Fed, even this year, is still adding bonds to its balance sheet? So if we look at the total assets on the Fed's balance sheet, they're up 2% this year, which is pretty incredible. We have the highest inflation rate in over 40 years. And the Fed is still adding bonds to its balance sheet. Now we know that that's going to start reversing course from here and go down. But what possible justification does the Fed have for keeping adding bonds to their balance sheet in the face of higher inflation pretty much every single month for well over a year now? So these are, I think, important questions that people should be asking. And then on the fiscal side of things, there was also no mention at the press conference and of what the fiscal policy and the role of the stimulus bills had on the inflationary picture, particularly that third stimulus, which happened after the economy had already fully recovered in terms of GDP, and earnings in the S&P had already fully recovered. Now you're adding an additional stimulus bill. Well, what effect did that have on the inflationary picture? And if we look at the national debt, remember before 2020, we were at 23 trillion. So it's $7 trillion expansion. So we're at over 30 trillion today. So all of these things are factors. There's obviously not any one factor that led to the stagflationary period that we're in today. But I think in order to prevent it in the future from occurring, we should at least start to acknowledge what were some of the causes. And I think to say that monetary policy and fiscal policy played no role in this, I think would be disingenuous and kind of the wrong message to be sending at this point. I think they need to maintain, in order to maintain credibility, they not only have to raise interest rates and normalize policy here, but also come clean in terms of saying what their role was in this and what they've learned from that experience in terms of not doing it again in the future. So in terms of the where we are in the bear market and what's different, as we talked about this on the last week's video, well, we have this very different situation where the last 8 bear markets in the U.S., the Fed was almost immediately easing policy, and here we are. S&P's down over 24% now from its high, and the Fed has already hiked interest rates to 1.5%, and they're expected to continue to hike to well over 3%, heading into next year, and they're expected to reduce the balance sheet. So again, very different situation. It's hard to come up with any historical comparison unless you go back to the early 1980s, where Paul Volcker was tightening policy within a bear market. And the different situation, as we talked about from back then, was interest rates were already very high when he was doing that. Volcker hiked rates all the way up to 20%. And here we are still below 2% today. So a lot of year left, a lot could happen, but a very different situation that we're in today. Be very careful comparing any of the more recent bear markets to today because of this big difference in the backdrop. So let's talk about the U.S. consumer and really a stunning consumer confidence reading, really a continuation of the trend that we've been seeing, but regardless, still a remarkably low reading, the lowest reading we've ever seen. And really what's driving that? Well, inflation. So if we look at the responses to this survey from the University of Michigan, everybody's talking about one thing, and that's higher prices. And so we got the May CPI report, of course, 8.6% overall CPI, but very important, food at home at 11.9%. And then, of course, the energy costs in terms of fuel oil or gasoline or utilities still showing extremely high year-over-year increases. And the constant really reminder that I have to give in terms of this inflation report is that shelter number at 5.5% is still leading to an understatement of that overall CPI. So as we know, that number is widely understating things because the rents in the U.S. are up 15% over that last year, and home prices are up over 20%. So if they were using the actual number, we're looking at an actual inflation rate over the last year of well above 10%. And what's really been the thing that everyone's talking about in terms of every week you're filling up your car and you see that just that price going up more and more. And this is, I think, having the biggest impact on consumer confidence, is this kind of weekly reminder that things are just, the necessities are costing more. So for the first time in history, gas prices in the US above $5 a gallon. As you can see, it's really been a vertical spike over the last year. And we're now well above where we were in the summer of 2008 at 417 a gallon, peaking there. So hopefully we see some relief here. We're starting to see some signs in terms of crude oil coming down in recent days. So hopefully this will reverse course and we'll see more supply. But the big factor that would likely bring it down, of course, is the demand side. If we see a recession, see a slowdown in growth, you'll see very quickly, I think, commodity prices start to reprice. So one of two ways, obviously, we prefer getting there without a recession by an increase of supply. But one of a few ways this really has to come down because if it doesn't, it's going to crowd out other spending and lead to a slowdown in the economy. And we're probably already starting to see that, as we'll talk about in a little bit. So if we look at why the U.S. consumer is really feeling so bad, it's not just that prices are rising, it's that their wages are not keeping pace with those higher prices. So this is a chart just showing our hourly earnings adjusted for inflation. And now we have 14 consecutive months of negative hourly earnings when you adjust for inflation. So that's a long period of time where people are seeing really a loss in purchasing power, decline in prosperity for the American worker. And an incredible stat here is what I've called the wage growth mirage. You have a 12% increase in wages since early 2020 in nominal terms. But if you adjust that for inflation now, that's actually negative. So just a stunning reversal in terms of how people were feeling about inflation, where for a long time they were kind of dismissive of it. They were only seeing the positive effects. And certainly if your wages are going up, that's a good thing. But over the past 14 months, they've really seen the other side of it, where those increases in prices are outweighing the increases in people's wages. And that's why when we come to the next chart, people are really feeling so negative. So this is the consumer sentiment chart, and it goes back to 1952 index from the University of Michigan. And so consumers now at a level of 50 are feeling worse than they have ever felt before, which is kind of remarkable if you think about talk in terms of what happened during 2008 and the job losses during that period of time. And, of course, in recessions prior to that, 1990, 1980, 1973, 75. So you had recessions where stocks were down more. We've had 2008 where you had the housing collapse combined with a stock market collapse and high unemployment. Consumers today are really feeling worse than any of those periods if we look at this survey. And why is that the case? I think it's because they haven't seen this animal in terms of inflation in so long, and many of them in their lifetime. So if you weren't around in the early 1980s or late 1970s, this is really the first experience you're having with higher inflation. And when people haven't seen something before, they tend to fear it more, and they tend to be more concerned about it. And I think that's the situation we are today. So as you can see here, these gray bars are the recessionary periods. And with the exception of 2011, as we've talked about, pretty much every time you've seen consumer sentiment this low, you've been in a recession. So I think whether or not technically this is called a recession, it's feeling like a recession for people in terms of what's going on with their wages not keeping pace with inflation. And so the fear and the concern will, at some point, consumers are going to start to pull back in terms of their spending. And I think we're seeing signs of that if we adjust for inflation here. So if we look at retail sales on a nominal basis, they still look pretty strong, right? They're up 6.9% over the last year. That's above the kind of historical average of 4.7%. But most of that is just due to the increase in prices, right? So if you have the same quantities, but inflation's up, 8% over the last year, well, then that sales number is going to go up 8%. So if we adjust for those higher prices, we're actually seeing now declines in retail sales year over year. It actually peaked, retail sales adjusted for inflation back in April 2020. So we're not hitting new highs on an inflation adjusted basis. I think this is an important one to watch to tell you the strength of the real economy. And if we're going to have a contraction in terms of real GDP, it's going to be led by this factor. So that's the big question throughout the remainder of the year. Will the U.S. consumer really start to pull back on their discretionary spending and leading this to push down further where it feels more like a recession, and you have job losses, you have earnings really coming down, and all the rest of it. So that remains to be seen, but this is obviously the big concern for not only the stock market, but for the economy. Now let's talk about housing. This is something we talk about every week, but it's really front and center for me because it's really one of the most important things going on, in the economy. Housing is traditionally a very important factor. It tends to be a leading indicator, as we'll talk about. But what's going on in terms of affordability is something really we haven't seen in history in terms of the change in affordability in such a short period of time. So this is a chart showing from the Federal Reserve Bank of Atlanta, showing the percentage of your income needed to cover housing costs. And it's just really going vertical here. And it's a function of course, two things. One, mortgage rates rising just by a huge amount, and of course, housing prices skyrocketing. So this basically means affordability is plummeting, and this is another way of looking at it. This is the housing affordability index in the U.S. So lower levels means lower levels of affordability, and now we're at the lowest level since July 2007. So you have to go back sometimes. And this is using numbers as of April, and mortgage rates have only continued to rise since then. So we're likely looking at the lowest affordability in the U.S. if we're looking at current numbers that we've seen in decades in terms of the housing market. And as we've talked about, it's impossible that this doesn't translate into a correction in the housing market and a slowdown in demand. So just to put that to math in terms of what that rise in mortgage rates means for someone who's looking to buy a new home today. In January 2021, the 30-year mortgage rate was at 2.65%. So it was at an all-time low, and home prices at the time were around $400,000. Today, you have the 30-year mortgage rate up to 5.78%. Okay. And you have the average new home price at $570,000. So what that means is 106% increase in the monthly payment if you're using a 20% down payment over that period of time, from $1,294 a month to $2,671 a month. And this is just the mortgage payment. This doesn't include obviously rising insurance costs and property taxes, and of course maintenance and all the rest of it that have gone up by a large amount as well over this period of time. Just looking at the mortgage rates doubling. So this is the highest mortgage rate we've seen. Now you have to go back to November 2008 to see a mortgage rate this high. And the big kind of shock is how quickly it's happened. So if we look at the rise over the last 6 months, I went back in history, there's really only one period where we've seen mortgage rates rise this month and much in a 6-month period. And that would be in 1981. And so what happened in 1981? Well, the U.S. economy was in a recession, as we talked about. That was the period where Volcker was tightening policy to try to bring down inflation. And of course, he hiked rates all the way to 20% during that period of time. So you have to go back pretty much to the early 1980s to find anything comparable. And in terms of the housing market, this is just a huge shift in affordability. So we would expect a slowdown in demand, and that's really exactly what we're seeing. Last week, we talked about new home sales and how they really plummeted last month. And then we got data on housing starts. So new homes that are starting to be built. And what we saw there is a really sharp decline month over month. And now it's down 3% year over year. And so perhaps we're seeing the early stages of that correction in the housing market, which only makes sense given the drastic change in affordability. And why is housing important? Well, it tends to be an important leading indicator for the economy. So we've talked about how an inverted yield curve tends to lead recessions, while a downturn in housing tends to lead it as well. If we look back in history, the housing starts tends to peak, come down, and then you see a recession sometime later. And that's happened during most cycles. That didn't happen during the 2020 recession because it was just came out of nowhere with the COVID-induced declines. But pretty much every other recession going back the last 40 years has been preceded by a peak in housing starts. So this is something to watch pretty closely, I think, in the coming months. If we see a continued fall or a lack of a recovery, I think this is going to impact the overall economy. Housing is a pretty important factor in terms of discretionary spending. People spend a lot of money on their homes. And also, when home prices contract and home prices go down, people tend to feel worse about their situation, and they start to spend less money. So it's really the wealth effect in reverse in terms of what goes on there on the other side of things. So something we'll be watching closely in terms of the housing market. It's really something that we haven't seen in a long, long time in terms of a normalization of mortgage rates. And really, the interesting thing is that the Fed is just starting to really decrease their holdings of mortgage bonds. And so either the market has front run that move, as it often does, or we could even be seeing, perhaps we could be seeing 6% rates soon when the Fed really starts to unwind that balance sheet in earnest. So a lot of different factors impact the mortgage market, but just a stunning increase in a short period of time. Next thing I want to talk about is the iron rule of financial markets. So John Bogle once said the reversion to the mean is the iron rule of financial markets. What did he mean by that? Well, just that when things are at extremes, as we saw earlier, you tend to see a move back to historical averages, in both directions. And just a few charts illustrating that in recent years. One would be really the worst performing sector over the past decade, before 2021 were commodities. And really the best performer were NASDAQ 100 or high growth stocks. So here are two ETFs, one being the commodities ETF, DBC, and another being the ARK Innovation ETF, which is the representative for high growth stocks. And you can see the last 16 months, we've seen a mean reversion, a very sharp mean reversion, where the growth stocks are giving back most of their gains during that 2020, early 2021 period, and commodities are moving in the other direction. So just a very sharp move. And a second chart kind of illustrating that a similar theme would be ExxonMobil and Salesforce. So in August 2020, they took ExxonMobil out of the Dow. They added Salesforce, so taking out energy. And this was shortly after the point where crude oil went negative there in April 2020. So a few months later, take out ExxonMobil. They wanted to add more technology. They add Salesforce. And these are the returns since that point in time. ExxonMobil up over 180%, Salesforce down 36% and change. So this is something we actually often see in terms of Dow components. At the point where they're added to the index, you tend to see below average performance. When they're removed, you tend to see above average performance. And it's because of that mean reversion thing. The reason they're being removed is often because they're having a very long period of poor returns, which tends to mean revert. And the reason they're being added is often a long period of high returns, which again tends to mean revert. So I think the question for investors is at which point does it go in the opposite direction? Have we reached an extreme in terms of commodities and high growth stocks? And certainly we're getting closer to that point today. I think if you're just looking at commodities today and thinking that this run is going to continue and this chart is going to continue in the same direction, I think that would be mistaken. You got the high growth stocks are already down close to 80%. And any economic weakness in terms of people believing that the U.S. is in a recession, well, we could see what we saw in the back half of 2008, which is a collapse in commodities prices. So just be careful in assuming that the recent trends will continue. So, reversion to the mean is a powerful force. markets will always be there, and you have to be mindful of when things are stretched in either direction. So last topic, we always want to end with something positive here. It's been a difficult year. We talked about worst year for bonds in history. If the year ended today and it's not even close, stocks are off to the third worst start for a year in history. What's the upside? What's the good news from all of this downside? Well, it's been now you have a better risk reward for investors. So if we're looking at anything from treasury bond yields and 10-year hit 3.5% this week. So obviously much better risk reward for bonds. You're coming at 30 basis points in 2020. So the returns for bonds going forward, you would expect a higher rate of return. And why do we think that? Because the single best predictor of future bond returns is that starting yield. So this table I put together really illustrates that, where this is the starting yield by decile, and then it's showing you the forward 7-year return. So the higher the starting yield, the higher the forward returns. The correlation is almost 1-for-1, and the lower the starting yield, lower forward return. So we were in this lowest decile. Now we're in a better point. So if you're expecting, if you want to predict what bonds are going to do in the next week or the next month, good luck. All of that depends on changes in interest rates. But if you're looking out 5, 6, 7 years in terms of the bond market, well, now you could be reasonably expecting 3 to 4% in terms of annualized return, which may not seem great with 8% inflation, but obviously it's much better than close to zero where we were a few years ago. And so treasury bonds are not the only area that's improving. High yield bonds also exhibit the same type of relationship, where you have the higher the starting yield, the higher the future returns. And as we talked about last year, I wrote a piece about it. Bond yields had never been lower in history in terms of the high yield bond market. Investors were so exuberant, interest rates were so low, spreads were so tight that you had the situation where high yield bonds actually yielded below 4% last year, just really pretending extremely low future returns going forward. And now we've seen an adjustment. High yield bonds have sold off very hard so far this year. And now we have the average yield on a US high yield bond index at 8.3%. Okay, so that's a better point for high yield bond investors. Can it go higher? It certainly can. We've seen it a number of times go above 10%. And back in 2008, when you had the financial crisis, it went over 20%. So certainly could get more compelling in the months to come. If there's a full-fledged recession and that starts to be priced in, you would expect it to go, I think, to double-digit percents in terms of the yields, but much better than it was a year ago when we hit all-time lows. So again, forward expectations better for investors in terms of high yield bonds. And lastly, the stock market. So all of last year, I talked about, writing about, people probably were getting sick of hearing me talk about it. Valuations were really stretched. If we look at things like the CAPE ratio or the Shiller PE, it was at its highest level since the dot-com bubble here. So you have to go way back here. And really, other than that, there was no comparable period in history. But now with this correction, we have stocks, S&P down close to 25%. We're in a better place. You can't say really that we're cheap in a historical basis, but certainly better than we were 6 months ago. And if we look at why that's important, as I've talked about, valuation means nothing in the short term. Like interest rates, it tells you nothing about the next month or the next year. But if we look at over long periods of time, let's say the next 10 years, it tends to be a pretty good predictor of future returns. So the lower the starting valuation, the higher the future returns on average, and the higher the starting valuation, the lower the future returns on average. So we were really in this bucket here, and and stretched in this bucket in terms of expectations, because valuations were really at their highest levels since the dot-com bubble. But now with that correction, it's gotten better. Now, are we at the point where we'd be expecting, double-digit returns? Probably not, but certainly much better than we were. So if you're a diversified investor, 60-40 investor, anything, you have a mix of things in your portfolio, well, pretty much everything with the exception of commodities is down this year. And so your expectations for future returns are higher. So that's the upside of downside. If you're a net saver, if you have 20 years to invest or more, if you're reinvesting dividends and reinvesting interest back into new things, well, that's going to lead to better returns going forward. So if you have a long time frame, as I talked about, it's very tough to stomach these declines, but that's really the best thing that could happen to you. Again, if you're adding to your 401k every 2 weeks or your IRA, you want to be buying in at lower prices. You don't want to be buying in at higher prices. It really only matters when you start to withdraw it. But the interim, you want to be buying in at better valuations. So that's the good news for investors. I know that's hard. It could certainly get worse before it gets better, but these charts would really just continue to ring true. If yields continue to go up, if the 10-year goes to 4% or 5%, well, then your expected returns are going to continue to go up. And if stocks continue to go down, valuations are just going to get better. So no one knows where that stopping point is going to be. But if it continues and you're a long-term investor, you should really welcome that, as a positive for the future. So that's it for this week. Everyone, have a great weekend, and we'll see you next week. Bye.